What if I told you that choosing the wrong ETF could quietly cost you hundreds of thousands of dollars and you'd never even know it happened? A few years ago, I was sitting at my friend Jason's kitchen table. He's the spreadsheet guy. You know the type. Maxes out his Roth, tracks every penny, reads earnings reports like bedtime stories. And he looked me dead in the eye and said, I put everything into VOO. I don't need dividends. I just want growth. Then he flipped his laptop around and showed me something that hit me like a brick. Two portfolios, same starting amount, one in VOO, one in SCHD, same time frame, but the outcomes wildly different. And not just in total return, but in how those returns felt along the way. And that's the trap most of us fall into. We chase the ETF that's louder, shinier, or just more talked about. We assume it's the best, but assumptions cost money. Real money. So in this video, we're doing something different. We're not just comparing two ETFs. We're going deep into real history, real data, real money. $100,000 invested, two paths. One focused on high growth, the other on consistent cash flow. And what you'll see by the end isn't just which one won, but which one fits you right now better than the other. Because here's the truth. The ETF that builds you wealth may not be the one that makes you feel wealthy. This is not just a numbers breakdown. This is about how to think like an investor, not just a follower. Stick around. This is Golden Goals. I'm Mike. Let's go. Setting the stakes, why this matters. Most people treat investing like picking a favorite sports team. You cheer for your ETF, check the charts, maybe even brag a little. But let's be honest, this isn't a game. It's your future. Whether you're 28 and thinking, I've got time, or 42 and realizing retirement's closer than you thought, where you put your money now has a ripple effect. We're not talking about small differences either. We're talking six figures over time. Enough to buy a home, send a kid to college, quit a job you hate, or never worry about gas prices again. When you invest $100,000 into something like VOO or SCHD, you're not just investing in companies, you're investing in a lifestyle you hope to live. The wrong choice? It won't ruin you, but it might delay your dreams. The right one? It compounds your freedom. That's why this comparison matters, because while both VOO and SCHD are excellent ETFs, the one that serves you best depends on where you are, what you need, and what you believe about money. Let's get into it. Understanding VOO, the growth engine. VOO is the Tesla of ETFs. Everyone talks about it, everyone recommends it, and for good reason. It tracks the S&P 500, the 500 biggest companies in America. But here's what most people miss. VOO doesn't just represent the market. It is the market's narrative. As of 2025, over 30% of VOO is in tech. That means when companies like Apple, Microsoft, and Nvidia win, you win big. It's powered by innovation, disruption, and the endless appetite for growth. Between 2011 and 2025, if you had invested $100,000 into VOO and reinvested dividends, you'd be sitting on over $635,000 today. That's a 535% total return. And it's not magic. It's math fueled by compound growth in high-performing sectors. And here's the kicker. VOO has an expense ratio of just 0.03%. That's almost free. Your money stays in the market, not in fund manager pockets. And with over $1.3 trillion managed, liquidity is never a problem. You want in or out, you're covered. But all this performance doesn't come without risk. VOO rides the highs of tech booms, but it also takes the full brunt when things crash. So if you're betting on the future of innovation and don't mind a bit of turbulence, VOO is your rocket ship. Breaking down SCHD, the dividend dynamo. Now let's talk about SCHD, the ETF your dad might own, but your future self will thank you for buying early. SCHD isn't trying to chase headlines. It's built for consistency, cash flow, and calm in the storm. It tracks the Dow Jones U.S. Dividend 100 Index, which means every company it holds has a 10-year history of paying reliable dividends. But here's the genius. SCHD isn't just about fat dividend checks. It filters out garbage. It screens for companies with strong cash flow, low debt, high return on equity, and real financial health. In other words, it doesn't just look for dividend payers, like it looks for survivors. It's why you'll see names like Coca-Cola, Verizon, and Cisco in the top holdings. Companies that don't move fast but don't fall fast either. As of June 2025, SCHD had a dividend yield of 3.92% and has grown $100,000 to $485,000 since 2011. That's a 385% return. Lower than VOO, yes, but often with less drama. Its expense ratio? Still ultra low at 0.06%, and it's managing over $68 billion. Proof that income investors trust it. SCHD is like the dependable friend who always shows up. It won't impress you at parties, but it might help you pay for one. Understanding VOO, the growth engine. VOO isn't just an ETF, it's the financial world's MVP. It tracks the S&P 500, a collection of the 500 largest U.S. companies. Basically, the scoreboard of American capitalism. And inside VOO, you're holding a basket of household names. Apple, Microsoft, NVIDIA. As of June 2025, over 30% of the fund is weighted in tech alone. That's not a flaw, it's the strategy. VOO thrives when innovation dominates. And over the past decade, that dominance has been real. The tech sector exploded, and VOO rode that wave all the way to the top. But it's not just about the names inside, it's how it operates. VOO is passively managed, meaning it's not trying to beat the market. It is the market. That keeps fees razor thin at 0.03%, which means more of your gains stay in your pocket. Now here's the part most people don't realize. VOO isn't a guaranteed winner. It's a growth vehicle. And like any high-performance engine, it runs hot. When the market's up, VOO soars. When it's down, you'll feel it. Tech-heavy means you get the good and the bad, amplified. So the real question is this. Do you have the stomach for the ride? Because the destination has been impressive, but it's not for the faint of heart. Breaking down. SCHD, the dividend dynamo. If VOO is the rocket ship, SCHD is the freight train. Slower, steadier, and built to carry weight through storms. SCHD doesn't chase growth. It focuses on financial health, dividend consistency, and long-term stability. It tracks companies that have paid dividends for at least 10 years, but it doesn't stop there. It applies strict filters: cash flow to debt, return on equity, 5-year dividend growth. If a company's not solid, it's not getting in. So what do you get instead of the flashy tech? You get consumer staples, energy, industrials, and healthcare. Think Coca-Cola, Verizon, Cisco. As of 2025, SCHD only had 8.9% in tech. By design, this gives SCHD something VOO doesn't: predictability. It pays a consistent dividend, 3.92% as of June 2025, and historically reinvested those payouts with quiet strength. And here's the twist. It's not boring. Since its launch, SCHD has returned nearly 385%. Just not as loudly as VOO. For many, especially those seeking income or nearing retirement, SCHD offers something VOO can't. Peace of mind. Fewer ups, fewer downs. Just dividends doing their job, month after month, year after year. The 100K simulation. Backtest and historical results. Let's stop guessing and look at what really happened. What if back in October 2011, you split $200,000 between these two ETFs, $100,000 into VOO and $100,000 into SCHD? You didn't touch the money. You reinvested dividends. No timing, no trading, just time and patience. Fast forward to mid-2025. VOO turned that $100,000 into $635,000, a 535% total return. SCHD, it grew to $485,000 and a 385% return. Both solid, both life-changing. But that $150,000 gap, that's real. That's the cost or benefit of your choice. And it tells a bigger story. VOO, driven by explosive growth, outperformed. But it did so with more volatility. Here's what's even more surprising. During the sharpest drop, March 2020 COVID crash, both ETFs fell by nearly the same amount. VOO dropped 33.99%, SCHD dropped 33.37%. So despite SCHD's reputation for stability, in extreme crashes, it didn't offer much more protection. This proves something crucial. Neither ETF is bulletproof, but each offers value if you know when and why you're using it. So now that you've seen the numbers, the question isn't which one is better. The real question is which one fits your life? Downturn resilience. What happens when the market crashes? Let's talk about the moment that truly tests every investment, the crash. In March 2020, the world froze. Markets tumbled. Fear was everywhere. If you had money in the market, you felt it. Some investors panicked. Others held the line. And here's what's fascinating. You'd expect a dividend-focused ETF like SCHD went with its safe companies to cushion the blow better than VOO, right? But the data says otherwise. VOO dropped 33.99%. SCHD dropped 33.37%. Basically the same gut punch. This moment taught us something important. Even the safest seeming investments can tumble in systemic shocks. Dividend stocks aren't immune. They can drop hard too. What mattered more than what you were holding was what you did next. Those who stayed invested, who kept reinvesting, who trusted the long-term plan, they won. And that's a mindset more powerful than any ETF. Mindset shift. There is no one-size-fits-all ETF. It's tempting to ask, which one is better, VO or SCHD? But that's the wrong question. The real question is, where are you in your financial journey? Are you 32, building wealth, focused on maximizing growth? Or are you 48, starting to think about income, stability, and protecting what you've built? VOO might be the better engine if you have time and tolerance for volatility. SCHD might be the better shield if you want consistency and cash flow. Neither is right. Both are tools. And choosing the right tool starts with understanding your stage, your needs, and your goals. That's what most investors miss. They chase returns instead of designing a life. Hidden insight. The power of combining VOO and SCHD. Here's the part no one talks about. And it's where the smart money plays. You don't have to pick one. The most effective investors don't bet on single strategies. They build portfolios. They use VOO for growth, SCHD for income, and together, you get a balance of capital appreciation and steady dividends. Risk and reward, upside and cushion. It's not about timing the market, it's about structuring your plan. One ETF can help you grow, another can help you stay calm. Both can help you build a life you don't want to retire from. So here's the final truth. Whether you invest in VOO, SCHD, or both, what matters most is that you're investing on purpose. Not chasing, not guessing, strategizing. You now know what each ETF brings to the table. You've seen how $100,000 grows differently depending on your path. Now it's time to take control of yours. Hit that like button if this helped. Subscribe to Golden Goals for more real talk, no hype finance. And remember, wealth isn't just about money, it's about what money lets you do. You've got the goals, let's build the future to match.